Good morning, good afternoon, good evening, depending on whichever time of the day or time zone you're tuning into this video. On behalf of my channel, the Nimbus Studio, I warmly welcome you to an exciting session on riding the delta. So, what essentially are we going to cover? We're going to cover how anyone can make significant profits out of the delta price movement of underlying assets. And yes, we're going to cover what is the most popular and accessible asset that everybody understands and has an opinion on, and that is stocks. So what is the main before I even get started, let me tell you that I am not having any scripted session with me, so I'm going to make it as extempore as possible, as a classroom session. So a lot of times I'm going to be finding myself going back and forth in articulating my thoughts. So my humble request for all my viewers is to be able to stay tuned till the end of the video for you to get possibly the maximum insights I can share that I know in this domain. So I could be really going back and forth. Sometimes the same thing that I said a few minutes earlier, I could probably be able to fine tune it as I progress. So with that disclaimer, let me get started. The other thing I want to put up my hand up front and say is that this is not a video about any specific trading strategy or specific money making technique. There are ample experts out there who have already put up a lot of videos which can be actually leveraged to actually implement trading strategies, but most of those videos assume already a kind of a basic level knowledge of all the terminologies involved, and you may not be able to leverage the full meaning of those videos if you go in as a totally novice user and not know the basic terminologies involved. So this, I am trying to operate at the extreme fringe level where I want to cater to all the novice participants out there who don't know most of the terms, or perhaps even if they know the term, they may have only a casual knowledge of it. They may not know the deep knowledge of those terminologies for them to know why it was coined as a term coined as a term like that in the first place. With a deep understanding of all the terminologies involved, you'll be able to make or leverage the full bang for your buck if you are paying for those training videos or training webinars. So with that disclaimer, let me get started with the topic. So what's the most inclusive way in which all market participants can make significant profits out of an underlying assets price movement? Everybody knows that what is a gain. A gain is only when you buy high. You buy low and sell high. This is the only way you can make profits, right? So what are the constraining or limiting factors, or put it another way, what is the most inclusive way in which everybody in the market can make significant profits? Typically the constraining factors are the amount of capital that one needs to bring in, right? If you are either able to bring in your own capital, you are HNI. If you are able to borrow, you're still HNI because you just don't prefer bringing your own capital. Anybody giving you loan will look at your net worth anyway. So if leveraging the price movement involves huge capital outlay, it shuts out almost 60 to 70% of market participants out of a window of opportunity. So I'll give a numerical example itself. Let's take a very popular stock in the Indian market, something like Reliance, which typically trades in the values of 2200 to 2500. If somebody wants to leverage a price movement of 80 to 100 rupees on this, right, but wants to make that profit on a volume of 1000 stocks of Reliance. How much is the capital that one needs as an investment to even leverage this price movement? It is 22 lakhs or 25 lakhs. Either you bring in your own capital or you have to borrow a portion of that capital. Nothing comes free. Either you have to repay the capital, borrowed capital, before the price movement was in your favor, or if you are waiting for the price movement to be in your favor for a longer time, you still have to service the debt by paying interest at high rates. So if neither of this is what is within the realms of possibility for you, what is the option available for you to leverage such a price movement? I wantonly used the term option because we're going to look at the instrument called options in this video session. Options is a derivative instrument that exactly allows all market participants to operate as a HNI, which means you can operate on volumes of thousands of shares on even blue chip stocks like Reliance, and you don't need to bring in 25 lakhs of capital for that. Sounds exciting? It is definitely exciting, but you need to be patient to understand all the terminologies involved. So let's first understand some basic terminologies and how markets have evolved for you to be able to understand all the terminologies involved, right? So basically, markets can be understood in two dimensions. There is a primary market and there is a secondary market. You need to understand these terms very clearly. Primary market is nothing but buying an asset directly from the owner of the asset or the initial manufacturer of the asset, or whatever you call it, because I'm trying to use complicated terms more to make it inclusive to all asset classes, because the concept of options underlying asset actually applies to all asset classes, not just stocks. We talk about stocks because it's traded on an electronic exchange and it becomes easy to trade on derivative instruments on underlying stocks, but the conceptual clarity throughout this session, I'll try to keep the words slightly generic for you to understand it in any asset class context. Primary market is when you directly buy from the issuer of the asset or the owner of the asset or the manufacturer of the asset. Not owner may not be the right term, the issuer of the asset or the manufacturer of the asset. So even in a real estate context, if you're buying let's say a property directly from the builder, you're buying it in the primary market. But let's say if you are after buying it, if you're selling it to another potential buyer, then you're operating in the secondary market. So secondary market is where the asset changes hands for a price consideration. Why you need to understand these terms will become more clear as we explain the terms involved in options, the roles, especially whether you're going to be an option writer or an option buyer. So you need to understand primary and secondary market from that perspective, definitely. So not many people know that or realize that the term stock exchange itself refers only to the secondary market. You need a vibrant stock exchange or a secondary market for even the primary market to exist in a healthy way. For example, unless a company's shares are traded in a secondary market actively, it means the stock is not liquid or is not tradable, and obviously various market factors will make a stock illiquid, right? Such a stock, unhealthy stock, if it comes for a next primary issue of shares, it will not fetch a very good price premium on top of the par value of the share or the face value of the share if it's a very illiquid stock. So the healthy secondary market of an asset is what ensures a healthy primary market for future fundraisers for that asset. You can relate it to a builder's reputation. If if a flat, if a building is not saleable, the next project that the real estate builder is going to announce may not sell well. That's the kind of parallel that I want you to keep in mind. So now that we've understood basically that there are two types of markets, primary market and secondary market, let's understand how secondary market works. Obviously, if somebody has to buy, somebody has to sell, right? So a market, a vibrant market exists only because there are two opposing perspectives of any asset. The buyer thinks that the future price of the asset is going to go up. A seller wants to exit his position and say, thus far no further, I want to exit this asset. So he probably thinks it may not go up. That's one way of looking at it. He may say, this much profit is enough for me, I am exiting this asset and I am transferring the asset to another person. So the buyer and seller operate on opposing perspectives. Now depending on which perspective is dominating in the market, you call it either a market in a bullish trend or a market in a bearish trend, right? Because whether the market is in a bullish trend or a bearish trend, you need both buyers and sellers. It just means that in a bullish market, people with a bullish perspective are dominating the market, whereas in a bearish market, people with a pessimistic view or a bearish view are dominating the market. That's what it essentially means as a trend. So why the term bull and bear in the first place? If you understand it with a very interesting anecdote, it actually ties back to how both these animals attack their victims. So a bull, typically what it does, it uses its horns to hit at the bottom of the victim and lift him up in the air, right? You might have seen this in a lot of these Spanish videos. That's how a bull attacks in a bull ring, right? So that's why a market in an uptrend is called a bull market. And how does a bear attack its victim? A bear strangulates at this point and tries to make you fall down. So it's also called, that's why it's also called a bear hug. So a market which is going down is called a bearish market. So once you understand terms with such interesting anecdotes, you will never miss the point when somebody uses these terms casually, right? That's essentially my intent in sharing such interesting anecdotes for the terminologies involved. So now that we have seen that how an underlying asset has something called a primary market and a secondary market, and secondary market has bullish and bearish trends and all that, it's still not within the realms of everybody who trades in the secondary market to leverage the delta price movement in a significant volume, as we just saw in the case of Reliance with an example. You need to bring in that much amount of either own capital or borrowed capital. So what is the way out? The way out is a class of instrument called derivatives, and a derivative is nothing but an instrument which is pegged to an underlying asset. And the best derivative instrument, which is the most democratic one, which everybody in the world in the investing world or the stock trading world can leverage, is options. Now what are options? Unless you understand it at the most fundamental level, you will not be able to understand any of the terminologies involved. An option is nothing but a right without the obligation to buy or sell an underlying asset at a predetermined price before a particular expiry date. That is all there is to it. So an option is nothing but a right to, and not an obligation, which means you can say no at the end of the expiry period, to either buy or sell an underlying asset at a predetermined price. And obviously it cannot be an indefinite thing, otherwise it's a lopsided deal. Finance operates on very logical principles of risk versus reward. So obviously if you cannot bring in the entire capital to buy the underlying asset, you only want a derivative form of the asset and you just want to own a right on that asset, obviously it will be time bound. So if you feel that you can take a right call of the direction of the asset's underlying price movement by a particular date range, then you can buy a right on that asset without constrained by any obligation to buy or sell that asset for a predetermined price, and you can leverage the price movement. So obviously we're talking about buying a right on the asset. So does anything come free in this world? Nothing, right? So the price that you pay for buying the right is called the option premium. That's all you have to pay. So you have to pay something called a premium to buy a right on the underlying asset. So you pay X amount of rupees to buy a right on an underlying asset like Reliance, to trade it in a particular direction of either buy or sell, right, at a particular price before a particular time. So let me now go into specifics, give an example for you to internalize this very clearly. I'm going to use the actual notations that you see in the instruments or what do you call notation itself. But even before we go into that, we need to understand that there are two types of options. One is a call option and another is called a put option. A call option is nothing but the right to buy an asset at a particular price, whereas a put option is the right to sell the asset at the particular price. So a call is linked to the right to buy, because in the definition itself we saw it's either a right to buy or sell. A put is a right to sell. So why we need two new terms, right? You need two new terms because an options contract itself can be bought and sold. So the terminology of buying an option and selling an option should not confuse you with respect to the term involved with respect to the direction of the underlying asset, right? Logical, right? So you cannot say I am going to buy an option to buy an asset. It becomes very confusing. So instead you simply say I want to buy a call option. Make sense? I am going to buy a put option, or I am going to sell a call option, or I am going to sell a put option. This reads well. You are able to intrinsically make sense of this statement, right? That's the reason why you need two new terms. So why is it called a call? Something similar to the bull and bear example only. What do you typically say when you buy a property for, let's say, 40 lakhs? You end up seeing the appreciation for it and sell it. You buy it at 40, you sell it at 60. What do you typically say? You pat yourself on the back and say, I took the right call on the asset, right? That's why a buying decision is probably called a call option. I'm saying probably because this is how I internalize the meaning. This need not be the textbook meaning of why we call it as a call option. Why we call it a put option? It is because something which is at 60 is going down to 40. It's being put down in value. So you say anything to do with leveraging the decrease in price action is called a put option, a putting down effect, if you will. Again, these are not textbook definitions, but these are my own definitions for you to understand or relate to when somebody quickly says call and put. So just for you to keep in mind. So now Let's look at the actual notation of an options contract for you to understand what it's all about. A options contract is typically listed in the exchange with such a notation: CE, then the underlying asset, let's say Reliance 2200, 30th June, XX. I'm not putting the year because you might be seeing the video in 2022, 2023, 2024, I don't know. So I'm just trying to make it a very generic representation here. So it will actually say the year. So a put option will be the notation of that will be something like this. I'm just putting a different predetermined price just to contrast it. Let's say we go for the same expiry date. So what does this mean? Let's understand the first notation and the first contract. So any person who's buying a call option, the first call option, is essentially buying a right to buy Reliance at 2200 till the period of 30th June. A person buying a put option is buying a right on Reliance to sell it at 2000 till 30th June. He has this right. But why is it a right and not an obligation? We need to understand that, right? Suppose this has to be understood as with respect to what happens on expiry date. Okay, let's say on expiry date the contract expires and the underlying asset price, for example, the underlying asset Reliance is trading at, let's say, 2500. So the market has risen to 2500, whereas I have a right to buy it at 2200 itself. So I will exercise such an option, because what does this mean? I can buy it for 2200 and sell it at 2500 and pocket the 300, isn't it? Suppose the price of Reliance was 2000, let's say the price of Reliance was 1900, right? Will I exercise the options contract? Will any fool buy it at 2200 when they can get it in the market itself for 1900? No. Plain common sense. They will simply allow the option to expire worthless. But obviously they would have paid the option premium, right? The option premium is the only risk to the capital. That is what I want you to understand. When you allow an option to expire worthless, it means that you will bear the risk of capital to the extent of option premium. And trust me, that can be very low amount, that can still not damage your individual net worth so much that you are out of the market in one shot, right? So that's essentially the best part about options. You can start small, start trading in small capital. If you hit a jackpot, you can see 5x and 6x of that capital if you take the right call. And you can try this experiment over multiple iterations of, at the risk of just losing that small capital, till you get it right, until you understand markets well. So that's the power of options. So let's look at the same scenario in a put options contract. Put option for Reliance, I have the right to sell it at 2000, 30th June till 30th June XX, right? So what's going to happen? Sorry, so just give me a minute. Just a minute, sorry. So I have a right, I have a put option contract on Reliance to sell it at 2000 till 30th June XX. So what's going to happen on 30th June? I should not go near the slider. I should be very careful. Please bear with me. That's better. So what's going to happen on 30th June XX in two scenarios? Let's say the price of the market has already risen to 2200. Will I sell at 2000? Will I be foolish enough to sell Reliance at 2000 instead of selling it at the market for 2200? No, right? You will allow it to expire worthless. But if the price of Reliance was 1900 in the market, 1900 in the market, obviously I have a better contract. I have the right to sell it at 2000. So I will exercise that put contract. What does that mean? I don't even have that stock in hand. So what am I selling? Right? That's exactly what you need to understand. At expiry, what happens is the reversal action takes place. The exchange automatically takes care of such headaches. The exchange buys it at 1900 for you as an option holder and sells it at 2000 for you. You don't have to do anything but just watch the terminal. It's as simple as that. You will pocket the 100 rupees of delta. And for what? You might have ended up paying only a premium of 25. You might have ended up paying a premium of 25 rupees to buy 1 unit of the option, and you would have made 100 rupees of delta. So by bringing in 25 rupees for 1000 shares of underlying asset of Reliance, you can make 1 lakh profit, roughly 4x returns. This is the power of options. Now let's first understand. Now this is the exciting world of options. Now what is this all? Can anybody get it right if this is the only way in which money can be made in options? No. That's why I want you to understand the term options premium in further more detail. The options premium is made of two components. One is called the intrinsic value and the second component is called the time value. If you don't understand this, you cannot leverage options as a trading instrument at all, because again one need not operate on the constraints of buying an option as it is issued first by the primary issuer of the option and you have to wait for the expiry of the option. That's not the only way you can hope to make money in options trading. That's probably something that nobody can get it right as a call, right? Most of the time your options might only expire worthless if you have to wait for an entire month's duration for your bet to come true on a stock. So if you understand option premium, then you will understand how the option as an instrument itself gets traded in its own secondary market and how the intrinsic value time value combination keeps undulating as the underlying asset keeps moving. So intrinsic value and time value. So let's first understand intrinsic value in the context of a call option. Let's understand this graph. This is time, this is price. What is the price? Underlying assets price. And this straight line that you see here is the 2200 of the predetermined price. The other term of referring to this predetermined price of any option is called the strike price. Strike price. There are other terms also called exercise price. Obviously I think intuitively you understand why it's called exercise price, right? You are exercising the right of the option, so it's called the price at which it is exercised. The more popular or colloquial term is strike price. So this 2200 line represents the constant strike price in which you can buy Reliance, because we are talking about a call option. Let's say the underlying price of Reliance, underlying asset price of Reliance is something like this over the period of June, right? If you understand this chart, it cuts the predetermined price in a few places. either to go up or to come down below it. For a call option, whenever the asset is going above the predetermined price, right, it means it is having an intrinsic value or a positive intrinsic value. What does it mean? Every time it goes above 2200, what does it mean? At that point of time, if I exercise the option, it means I can buy it for 2200 and sell it for a price higher than 2200 in the market. That's what it means. So that delta of underlying asset price over the strike price, let's say the current market price of Reliance is 2300, 2300 minus 2200, the intrinsic value of Reliance is 100 at that point of time. Okay, so if you take the same chart, for a call option, this portion, right, this portion is a zone where obviously the exercise price of the option 2200 is meaningless because the asset is available for a lower price in the market itself, which means it is having a negative intrinsic value, but an intrinsic value cannot theoretically be negative, so we call it an intrinsic value of 0. Okay, so the intrinsic value of an option is tied to the underlying assets price movement. Now what is a time value? Obviously we are talking about the next axis called T. We saw that the intrinsic value is determined by the price movement. The time value is obviously is dictated by the time to expiry. So let's say this is 30th June, right? This intrinsic value alone will not give the option premium. The fact that the intrinsic value was reached, let's say on 10th June itself, means that there are 20 more days for the asset to still perform in either direction, right? The market will price in a premium for the time value as well. Let's say the call option is for 2000, the price of the underlying asset is 2025, and there are still 20 more days to expire. So the intrinsic value will be 25 and the market will price in a time value of another, let's say 15 rupees, which means the option premium will be 40 rupees. So although you can buy it for 2000 and sell it for 2025 at that point of time, the fact that 20 more days remain for expiry will give additional weightage for this price movement, and you'll be able to make an additional 15 rupees, which means you'll be able to trade the option for an option premium of 40 rupees. Why I am saying trade is because there is still time left for expiry and you are actually trading the option to another option buyer who is willing to wait till expiry. That's what it means. So you can, that's the best part about options trading. Options trading is all about operating in the secondary market of options. So you don't need to wait till expiry at all. You can enter an option, Reliance option for 15 rupees and exit it. Let me not use X, it means something else. I can exit it for 40. So what are you doing? Buying low, selling high, and that's all about making the delta. And that's all, and you can operate in volumes of thousands and 10,000s depending on your risk appetite and risk capital, right? Can you ever imagine to make the 100 rupees price movement of Reliance with your own capital in the underlying asset, unless you bring in capital to the extent of 25 lakhs or 22 lakhs? That's I'm sure you're now getting the power of options trading and how fluid it is to make money. It is, this is the best part. See, I don't mind repeating it till the cows come home for you to internalize this. This is the strike price. This is the expiry date. This is the underlying assets price. Correct? Obviously it's undulating. You can never get this graph prediction right. But if you can get the trend right with the combination of intrinsic value and time value, right, you can always, this is the option premium price and this is the time to expiry. The option will have its own price chart. Okay, and this is a common representation whether you are buying a call or a put option. All you need to do is, whether you are dealing in a call option or a put option, you need to ensure you buy here and sell here. You don't need to wait. You don't need to wait till expiry at all to make money in options. You can still buy here and sell here. So even if you are able to get the prediction for the next week right in Reliance, you can make money, quick money out of Reliance or any stock for that matter. Now let's look at intrinsic value and time value in the context of put options. That will kind of make it even more clear for all of you. Let's say you have a put option. Let's say you have a put option on Reliance for 2000 expiring on 30th June, and you have a similar price pattern. Now this zone represents the intrinsic value for a put option. This represents zero intrinsic value. Why? Because if the underlying price is already higher than the strike price of a put option, it means it's worthless. I can sell it for a better price in the market itself. If the underlying assets price is lower than the strike price of a put option, it means you have a better contract of being able to sell it at 2000 by buying the asset in the market for a lower price. That's what this means. So the bottom portion is the positive intrinsic value, whereas the higher portion is the zero intrinsic value. The concept of time value is the same whether you're talking about call option or put option, right? So the time to expiry, the time left to expiry gives any option, whether it's a call option or a put option, the additional strength of price element called the time value. It's very important to understand time value, because you might find that, okay, let me introduce you to another important term. It's not a new term, it's something that you're already aware of, intrinsic value. Whenever the intrinsic value is greater than zero, we're now talking about call as well as put. Okay, whenever the intrinsic value is greater than zero, it means it is a in the money option. What does it mean? If it were to expire at this point of time, it's a contract worth exercising. It's in the money for you to exercise. Whereas if an intrinsic value is less than zero, it means it's an out of the money option. What does it mean? It simply means that option is out of the money. If I were to exercise it as on today's date, it simply will have to be allowed to expire worthless. So this in the money and out of the money is a term that you commonly will come across, people casually referring to an option tied to the current time. In the entire expiry timeline for an option, and the same option contract can be in the money, can go out of the money, can come back to in the money, and you can keep moving into and out of these zones depending on the underlying assets price movement. So why is understanding this term very important? If it were not for what is called the time value, you will not have to pay any option premium to buy an out of the money option. Correct? An out of the money option, let's take an example. Put option on Reliance 2000. I'm not going to specify expiry date. For one thing, I don't have enough space on the board, and by now it's quite clear for you. Let's say I have put option on Reliance for 2000. The current price is 2100, which means as a contract, this is a worthless contract. The market gives me ability to sell it at 2100. So a right to sell it at 2000 is practically worthless, which means it is out of the money. You will strangely find that such options are also traded in the market for very cheap values, like 5 rupees, 2 rupees, etc. What does it mean? Let's say an out of the money option is trading for 2.5 rupees and the intrinsic value is actually 0, but for argument's sake I will say the intrinsic value is minus 100 because the underlying asset is trading at 2100 and you have an put option for 2000. So the intrinsic value is actually 0, but I am just, for example's sake, I am taking it as minus 100 for just to drive home the point. This means the time value, which means the strength of the time to expire for this option is so great that the time value of this option is 102.5, giving it the net value 2.5 is equal to minus 100, which is the intrinsic value of the option at this point of time, plus the time value of 102.5. That's why you even have a price at which you can buy the put option. What does it mean? The market strongly believes that there is still potential for Reliance to go down. Currently it is at 2100, but if the trend line is to move downward, then which means what you buy for 2.5 as an option can be even successfully exited for 10 or 15 rupees as the underlying asset moves down. This is the power of options trading. Not only that, it means a call option and a put option helps you leverage upward price movement as well as leverage downward price movement. So what is the alternative for you to be able to leverage a downward price movement if you're directly a player in the underlying asset? Do you know? There is a concept called short selling. But what is the problem with that? What does it mean in the first place? It means I first short sell Reliance for 2000. I wait for its price to fall to 1900 in the hope of buying it for 1900 and giving a physical delivery of Reliance that I sold for 2000. So if you want to operate in volumes of 1000 Reliance shares, you need to be prepared to bring in 19 lakhs whenever the price goes down to even if the price were to go down to 1900, you need to still bring in 19 lakhs of capital to buy it and square off your position. On the other hand, the other problem is, what if Reliance shoots to 2500? You only have short sold it for 2000. It means whatever be the price you find the Reliance, you have to honor the obligation, which means you have to incur a loss of 5 lakhs. Do you get it? There is no cap on the risk of capital, which means the risk in options is limited to options premium, whereas your risk in short selling is unlimited. That's the risk of directly playing in the underlying asset. The underlying asset will not only involve bringing in huge capital, it also means the downside is unlimited. The downside in the sense the loss potential is unlimited. That's why options trading not only allows you, this is a quick recap. So options trading not only allows you to capitalize the delta, it helps you capitalize large volumes, right, without high risk. The risk is only limited to the extent of option premium. So what does it mean? No market can be predicted. Options allow you to, what does it allow? It allows you to take multiple iterations on betting on the direction of the market, because every time you only place limited capital on the table, a small percentage of your trading net worth is all that you need to place on the table as a risk capital for you to be able to see if you can get 4x 5x kind of returns in some trades. Which also means what? In one trade itself you can make up for 4 to 5 trades which you made a loss of options or you allowed it to expire worthless. That's what it means. So one good trade can offset almost 4 to 5 bad trades, and over a trading window of, let's say, 6 months, if you have broadly understood the concepts and you also take good training videos on option trading strategy, in a period of 6 months you will live to fight another day every time, and you may make 100 trades, and over a portfolio of trades you may make on initial capital of 50k. There are people who have made almost 6 to 10 lakhs of net gains because of the fact that only 15 trades were successful bets out of these 100. That's the power of options trading in a nutshell. So quickly, before we wind up, I want you to understand two terms: option writer or option buyer. An option writer is a person who is on the other side of the option. He holds the obligation to buy or sell without the right. The option buyer owns the right. So the option buyer pays the premium. The option buyer pays the premium. The option buyer pays the premium and the option writer collects the premium. Okay? But the option buyer has the chance to sell the option to another option buyer, which is called the secondary market for options, and allow the second option buyer to remain till expiry, and so on till option buyer N. It can be sold in the secondary market, and the option buyer N, the last person who bought the option, will remain on the expiry date. Whereas the option writer who collected the premium has to stay till expiry. What does this mean? You, as an option writer, you cannot exit the option, right, till expiry. You have to honor the obligation. Why I am saying all this is because options trading, I want to introduce this topic of options trading as a universal concept that caters to all market participants. Option writing is not meant for all participants, because the very fact that you need to stay till expiry and honor the obligation of buying the asset or selling the asset at that fixed price, irrespective of favorable or unfavorable market conditions on expiry date, it means that you need to have significantly high net worth to even write the option. The exchange platform will limit you from even writing the option if you don't show enough margin requirements to be able to honor the obligation on the expiry date. So please don't think it's very easy to write an option and collect its premium. It's not that easy. you need to have very significantly high net worth. So being an option writer is as good as being an underlying asset market participant. Please bear this in mind. Of course, let's say you own 1000 units of Reliance already in your demat account, okay? Then you have the net worth to honor any obligation of Reliance, right? Then you can coolly write put options on Reliance, because what does it mean? A put option is a right to sell at a particular price, which means as an option writer you have the obligation to buy Reliance, right? I'm sorry, I made a complete mess of it. One second. Let's say you own 1000 units of Reliance in your demat account. You can safely write a call option. What does it mean? See, somebody as familiar as me in terminologies can quickly get it wrong. That's the importance of this training session. Okay, I didn't do it on purpose at all, believe me. If you own 1000 units of the underlying asset and you feel that the price trend is such that it will not go down, right? You can safely write a call option. Why? Because what does a call option do? Let's take an example to understand. Let's say you write a call option for 2200 expiring on 30th June. Okay, when will anybody exercise this call option, the right to buy at 2200? Only if the market is already moved to 2500, right? Only then somebody will exercise this option, right? So if you are very confident that the price will not go above 2200, let's say you own 1000 units of Reliance, the current price of Reliance is 2000, you can safely write a call option for 2500 and collect its option premium. Why? If before 30th June you are very sure that Reliance will operate within 2200 to 2500, there is no risk of that option getting exercised and you can make risk free money off this option premium. Why? Even if you have to end up honoring the obligation of having to sell 1000 units of Reliance, you don't have to buy it in the market. You already have 1000 units of Reliance in your bag. That's the only scenario in which you can safely write options. So options writing is not a cup of tea for everybody who does not have the net worth to back the role of being an option writer. So very clearly we are talking about only trade of options, which means somebody writes options, you keep buying low and selling high. And I told you this is possible without even having to wait till expiry date and you can make money in the. So what are you actually doing? You are operating in the secondary market of the options contract. This is what you are doing. This is a very safe game and a low risk game for generating 4x 5x kind of returns, and sometimes even out of 15 trades out of 100, if you get it right, you may end up making overall 10x on your investment. That's the power of options trading. So with that exciting thought, I would like to kind of end this session and thank you all for your patience, and I really hope this was a rewarding session for all of you from the point of view of understanding options trading from all its intricacies involved, and I hope I've demystified most of the terms involved, because now I'm sure if you hear this video more than 1 or 2 times, you will internalize most of these concepts. So when somebody says buy an option, buy a call option, what does it mean? What does it mean to sell a call option or write a call option? What does it mean to buy a put option, or what does it mean to sell a put option? So I missed one term. So the fact that you're operating in the secondary market of options and you're buying low and selling high. The concept of selling to another options buyer, there's a interesting term, it's called square off. So you square off your position, that's all it means. So the process of selling an option to another option buyer is not the same as writing the option. You are squaring off a previously bought position. The bought position is being nullified with a sell transaction. So it's called a square off. So we are totally talking mainly about buying and squaring off call and put options as a very safe instrument with very low risk to your capital. You can deal with multiple trades on small amounts of capital and hope to get it right. As I told you, no market can be predicted, even cricket scores can't be predicted, right? So how can you predict a complicated thing like market? At best, you can try to get it right in a iterative set of trades. If you're doing 100 trades in 6 months in an underlying asset, you're dead by the time, or you need to be a high net worth individual to sustain 100 trades in the first place. Whereas in options trading, you can live to fight another day. That's what it means. You can keep risking 2%, 3% of your trading net worth every day. Try to do 100 trades over a period of 6 months. Try to get it right. Always do your own trading strategy, form your own insights. But with options trading, there's a very good potential that you can make almost 10x of your initial seed capital by over a portfolio of 100 trades, even if you get 20% of the trades right, which means 20% of those trades you have bought low and sold high, or you have exercised the option on expiry date without allowing it to expire worthless. 80 trades were either bought high and sold low with a stop loss, or you allowed the option that you bought to expire worthless. So even if 80% of those capital is lost, with just 20% of successful trades, you can hope to make anywhere between 5x to 10x of your initial seed capital, assuming your initial seed capital was something as low as 25,000 to 50,000. That's really the power of options trading. I have developed a very useful Excel sheet that allows you to track how much of seed capital you bought and how much of gains you made, and how you kept only reinvesting the gains you made, so that you can always track what was the end gain of, let's say you made 5x. How do you monitor this 5x? The fact that you brought in 25k and you made 125k in a period of 6 months, for example, how do you even keep track that you bought 25k and exited at 125k at the end of 100 trades? You need to keep a track of the seed capital and amount of capital gains you made, you kept reinvesting in the next options trading, right? So I have a very useful, user-friendly Excel sheet worked out for that. I'll share it freely as a Google Drive link in my video description, and I hope you are able to leverage that as well, because not many brokerage platforms give very user-friendly reports to track, especially this specific aspect of seed capital and how much returns you made on your seed capital, how much you spent on brokerage, everything. It will help you keep track on a daily basis. So I will share that Excel freely in the link to this video, and I really hope you find that very useful. Pardon me for any mistakes I might have made during the creation of the video. As I told you, this is a very extempore video that I did. I didn't have any script prepared. That's why I kept going back and forth in my articulation, and I really hope you stayed tuned till the end of the video and leverage the full knowledge that I wanted to share with you. Suppose I still have an afterthought of some more insights that I could share, I will probably put follow-up videos on short topics, because I'll be confident that you've gone through my first video to know most of the terms. So I'll probably quickly jump into that specific concept that I missed. So if you want to keep listening into those interesting videos and concepts, 2-minute videos that I might end up putting down the line, my humble request is subscribe to the Nimbus Studio. I once again thank you all for your patience. I really appreciate your time, and I really hope you get back this time invested in terms of multiple 10x, 20x, 30x. I really wish you all the good luck in life. Prosperity is something that needs to be shared openly. Only then it will come back in multiple times back to us. With that strong hope and message, I end this video. Good luck. Thank you.